if you're a young Australian and you're stressed about the future that we've inherited from the boomers, I actually have some good news. Would you believe that there's a secret escape hatch out of here? A way to get ahead that almost no one knows about, and it's just sitting there wide open if you know where to look. It's a concept called sweat equity. In short, it's about swapping your working time for ownership, and it's a real shot at building wealth without needing the cash to get started. My name's Charlie Earside, and 10 years ago, I had more or less nothing on paper. I did have a job that I hated, but I had no real direction, certainly no inheritance coming from mum and dad. God bless them. Now I've started companies worth nearly $1 billion, and somehow I got my mullet on the young rich list. In this video, I'm going to take you through exactly what sweat equity is, how to find it, how to own it, how to cash it in, and along the way, we're going to learn about why it's the last remaining way for young Australians to get ahead if you weren't born rich. And if you care about that, you care about Australia dreaming bigger again. And that's why I started this channel, to get Australia back to being the best at stuff again. So if that sounds like your kind of mission, like and subscribe. There's more of this coming. So let's dive into sweat equity. But before we get into it, why not have a little recap?
Which country am I?
Record house prices, their housing shortage, world-leading debt-to-income ratio, R&D levels at all-time lows, no wage growth. If you guessed Australia, you're correct. So things are pretty bleak in case you've been living under a rock and probably renting said rock from a boomer landlord. But with sweat equity, it's possible to get ahead and create what we should call generational wealth. It's about having the resources to comfortably have the next generation, to have kids, and also to look after them in the uncertain future that they may exist in. Basically the opposite of what the boomers have done. Sweat equity also powers community upside, where you're creating prosperity for people that you don't know and will never meet. You're building companies that grow, and as they grow, they create jobs, pay taxes. It's a beautiful thing, really. And it's something that Australia as a country has been lacking sorely. But if it's so great, why does sweat equity fly under the radar in Australia? Well, the first thing to understand here is that it's a new idea. It's made millionaires out of the early employees of Canva, Atlassian, my most recent company, Eucalyptus, as well. But that's only really happened in the last 5 to 10 years. It started with executives of public companies, think CEOs and CFOs, during America's post-war boom, as a way to align those executives with shareholders. It wasn't until the 90s that Silicon Valley technology companies started offering stock options, and they wouldn't just offer them to execs either. Famously, one of the people that did the best out of Facebook's success was the guy that did the graffiti wall. There are plenty of stories like this. In the last 10 years, sweat equity has become standard at startups in Australia. It's out there and it's ready for you to unlock. You just have to be comfortable zigging while the rest of the country zags and buys investment properties in Brisbane. Which is a great segue into the next segment, which is old ways to get rich in Australia. The first approach is the wartime approach, also known as Lotto. We love Lotto in Australia. It's an extremely low agency way to get ahead, but it was a good way, the government thought, to raise morale. Good luck, this Powerball, or the equivalent. Historically, the second way of getting rich was the buy houses method, also known as the boomer method, also known as the lucky country method, or as I like to call it, the clown car that fell into a gold mine method, which worked for a whole generation, but it's not going to work now. And the returns on property growth are, thankfully in this country, slowing, but that doesn't stop people being obsessed with it. The next way was the barefoot investor approach. This is the Gen X's favorite way. It was the safe way to get ahead, but now you can't really rely on getting a pay rise, and you certainly can't rely on your job existing. So fast forward to today, and it seems FIRE, financial independence, retire early, is the millennials' choice. It's great, but it requires monk-like control. And again, there's a lot of uncertainty with AI just around the corner. The last way, and the newest way, is sweat equity. So how do we do it? First, you need to find a private company that you want to work at. And this company is usually going to be less than 10 years old, an early stage growth company. What that looks like is usually a business in a technology powered industry. Think software, hardware, the deep sciences, because these are the companies that are more likely to have a share of the company set aside for employees. The way to find these companies is to research Australian venture capital firms and go to their portfolio and see what kind of companies they invest in. That's worth a whole nother episode, and we'll talk about that later. Okay, before you go any further, make sure that the company you're snooping sells a product and not a service. Service company equity is worth next to nothing on paper unless you want to be slaving away at the salt mines for the next 30 years. These companies will usually mention that they have equity or ESOP, employee share options plan. They'll mention it in the job descriptions on their website. So be sure to check. This is an example of a software engineering job ad for my company, Eucalyptus. I'm going to skip the part where you nail the interviews and get the job because you're here. So I'll just assume that you're a weapon and it's a done deal. Once you have the job, you get the equity every month. These are called options because they aren't actually shares. They're the right to buy shares in the company in the future at a set price. The reason why they're not shares is for tax reasons. You don't want to have to pay a big tax bill whilst you're working. So it's basically a legal document that gives you the right or the option to buy those shares in the future. The price you have to pay in the future for these shares is often extremely low. When you do get your options, you will have an agreement to sign, and it is a long legal document. So there is a lot to wrap your head around. That is a topic, not for today, for another day. And thankfully, in the meantime, my co-founder at Eucalyptus, Alexi Mitko, has written an amazing article on it, which I will link to in the description below. Now, I hate to be that guy, I truly do, but like anything in life, there are risks involved with sweat equity. Risk that you choose the wrong company, risk that that company doesn't grow, risk that that company fails and goes to zero. And along with it, your options and your sweat equity is worth not that much. It's actually worth nothing. So there are ways to mitigate that. It's definitely not the end of the world if that's the case. What you can do is give that company 2 amazing years, learn everything you can, meet all the amazing people that you might work with again in the future, and move on to another company and rinse and repeat until you find the right company that's growing quickly, you love working at, and is really onto a good thing. And then you can stay there. One of the biggest risks you can take is to take no risk at all in your life, particularly early on in your career. You can be very comfortable working for 30 years. The risk there is that you will watch your health erode, you might get depressed, and AI come and steal your job. So the question you've been wanting to know, as they say, when Lambo? When can I actually make some decent money out of this? When can I cash out these options? Let's use myself as an example at Koala, the first job that I had that offered options. Here is my share certificate. Now, not everyone at Koala got equity, and some of my co-founders in Eucalyptus actually missed out on equity in a very acrimonious way, shall we say. Things got rather spicy. So Koala's actually a great example of what not to do when you issue employee share options, but that's potentially a story for another time. All I will say is that when it's friends, make sure you read the contract. And we didn't read the contract until we left the company. So I worked at Koala for 2 years, from 2016 to 2018. And I worked out that I own about 0.07% of the company. Now, Koala is supposed to be worth $500 million. I'm slightly dubious on that number, but let's run with it for this example. 0.07% of $500 million is 350,000 Australian dollars. So that's a really nice house deposit in Sydney, or a secondhand Lambo. Now, the truth is I didn't actually know what I was doing when I negotiated for this equity, and 0.07% is probably on the lower end of what I think is possible now. Let's just say I negotiated for 0.25% of Koala when I was creative director, which I now know is in the realm of fairness. That's worth $1.25 million, which is awesome. It's real stop working for a while money. Okay, an important mental model here is that the earlier you join a company, the more sweat equity you get. And the reason for that is because a company earlier in its life is a riskier proposition. But if the company grows and becomes more valuable, the risk goes down. And so each option is more valuable. And therefore, as jobs come later, they usually get offered fewer options. So the options are worth more each, but you're taking less risk, so you get fewer of them. The trick is to join a company that suits your risk profile earlier, and you can get more options and have a bigger outcome. You can also have a bigger impact on that outcome by just being around at the company for longer. The later you join, the risk goes down and the more likely you are to get an options grant closer to the one that I received at Koala, which is good money and probably enough to get ahead, but it's probably not life-changing. Okay, so how do I cash in my sweat equity for real money? Well, historically, you needed to wait for the company to be sold or for the company to get big enough and list on the stock market, on a public market, so people could buy the shares. And sometimes, as we've discussed, you choose the wrong company and it never gets to an exit event. Thankfully, there's an increasingly common practice amongst companies that grow well called secondary. And secondary allows early employees to sell their sweat equity as part of investment rounds. We did this at Eucalyptus, and some of our team have sold part of their share in Eucalyptus for hundreds of thousands of dollars. Canva have done this too, and their early Canva employees are not insignificant part of Sydney's GDP today. Again, this is hugely reliant on you finding the right company because secondary is usually only offered to current employees and founders. So you really have to find the right place and stick with it and be there at the right time when the secondary transaction is going through. Otherwise, you'll have to wait for a more meaningful exit, like a sale or an IPO. Okay, so it's possible to get ahead, really far ahead, without an investment property with sweat equity, but that's only one way to do it. There's a really even faster shortcut. Shall we call it hard mode? I think so. It's starting your own company. And the things to know about starting your own company is A, it's really hard, and B, that's not a good enough reason not to do it because it's super rewarding. But let's break it down, what it means for you on paper. Okay, so the way you think about starting your own company is first, there's actually two types of company you can start. Two pathways. The first one is called growth companies. My most recent company, Eucalyptus, is most certainly a growth company. It's a great example of it. Growth companies are all about getting out of the gate really quickly. It's about developing a product, iterating on it until you find product market fit. And once you have that, scaling it to as many people as possible, often globally. And for that, you need money. You need lots of money and usually other people's money. And so what you have to do is raise money from investors. On this path, things happen fast. These companies grow much faster. They fail much faster, and you have to grow much faster. Really, you have to grow or die because that's what investors want to see. They want to see results. They want to see you hit your next milestone. And most importantly, believe it or not, they want to see you come back like little Oliver Twist begging for more money because you've learned something about your company and it's heading in the right direction. And hey, we need more money to hit the next milestones. And so this is a cycle that continues and continues, but the whole time your company is getting bigger. The whole idea here is that you're swinging for the fences. All right, but what about pathway 2? Now, let's call pathway 2 cash flow businesses. So some people call cash flow businesses lifestyle businesses. I find this quite condescending because I guarantee you, no matter what kind of business you start, if you do choose this pathway, you will have no life. The thing about a cash flow business that's different to a growth business is you typically don't raise money. If you do, it might be from your grandma. The great thing about that is that you own more of the business, but it typically grows slower. What you're after with a cash flow business is profits rather than growth. You're trying to get cash out of the company rather than growing the value of the company. There's also an important rule here, which is no services businesses. So we're talking agencies, consultancies, servicing clients, a tradie business where you're still on the tools. If you're trading your time for money, you're not building equity, you're building a job. So avoid. Okay, so how do each of these two paths differ on outcome? What's the expected return from each? Say we've got a growth company and you're starting it with one co-founder. This company starts by raising $1 million from investors at a company valuation, for example, of $5 million. Now, you don't have to understand exactly how this works, but basically, if the company is worth $5 million and you raise $1 million from investors, you're basically giving away 20% of the company. So that $1 million in exchange for 20% of the company. And so you and your co-founder own 40% each, but at least you have that money. If you do everything right, you'll keep raising money through multiple stages of investment. The rounds of investment in VC have cute names like pre-seed, seed, Series A, Series B, Series C, and so on, all the way through to Series I. These represent specific fundraising rounds, and at each round, a good rule of thumb is you can expect to give away about 20% of your remaining share. And hopefully, along the way, you also decide to carve out a chunk of the company, let's say 15%, for your employee share options pool. So by the fourth or fifth fundraising round, you might only have a 15% share of the business, but obviously that business is a lot bigger. While your piece of the pie shrinks, the pie itself is getting bigger. And the best growth companies can be worth over $1 billion by the Series B, Series C, Series D mark. Your 15% share of $1 billion company is $150 million. And that can all happen within 5 years. So what you've done is you've not only built an amazing company that's employed many people with that community upside we've talked about, but you've also enriched yourself and your family and your loved ones by about $30 million a year over 5 years. So you can see why this is a really attractive set of numbers, and one that a lot of young people that are in the know are actually starting to have a crack at, which is really exciting. All right, let's talk about the other option, the cash flow business. Okay, so with the cash flow business, we're focused on revenue as opposed to company value. So for an example, let's just say that you've created a $10 million revenue per year business, which is great, but also not out of the realms of possibility. I think you'd be surprised how many $10 million a year cash flow businesses there are just in your local community. But you and your co-founder have got 20% net profit. So $2 million a year of that 10 is profit, and you can split that 50-50. So after 5 years, you are able to pull $1 million a year out of that business after all your costs. And the great part is it's an asset that you now own a huge chunk of. You can continue to hold it and grow it as long as it makes you happy, keep it for many, many years. You can run it into the ground if you want. You can sell it to private equity. You have many options. And so even though the numbers there are potentially less impressive than the growth company route, there are so many benefits to this route. Some might say it's better mental health. After you get over a certain hump, it's sort of less relentless. I don't really buy that. I think that business people are generally quite relentless people, but it's definitely a valid pathway and something that's attractive to many people. So what's my pick? Well, I love the growth company route. It is extremely painful. It is high risk. It is a go hard or go home approach. You definitely got to have the stomach for it. You compress a huge amount of life learnings into 6 years. And that's part of the reason I'm starting this channel is I've got a lot to word vomit at you about all the things that I've learned about people and systems and incentives and life. And a lot of these lessons were painful. So it's a bit cathartic for me to get into them, but we will at some stage. Yeah, the growth company stuff is hard, and it will probably be your whole identity, which is a feature, not a bug. And then eventually later in life, it becomes a bug and you have to unpick it, your identity from the company. But yeah, it's a roller coaster, and it's definitely my pick if you're young, hungry enough, and have the personality type for it, which is not everyone. But if you're watching this, maybe you are a little bit broken in a way that you need to be to start a growth company. If not, there are other options. There's the cash flow businesses that we talked about, but I think for the majority of people, getting sweat equity at a growth company, being part of that journey, selecting the right company, and then cashing in on your options is secret, but should be known, should be shouted from the rooftops. Okay, that about wraps it up Thanks for watching. There's plenty more where this came from. As Rex Hunt said, yibbity yibbita. I'm not sure if he has that trademarked. Rex Hunt's legal team, come at me. See you next time.